Ladies and gentlemen, welcome to Wipro's second quarter fiscal 2024 quarterly earnings results. My name is Sandabar Groe. I'm the head of Global External Communications at Wipro, and I'll be your moderator today. Before we kick things, I want to introduce you to our executive leadership team on stage today. From your left to right, our COO, Amit Chaudhry, our CGO, Stephanie Trautman, our CEO, Thierry Delaporte, our CFO, Aparna Iyer, and our CHRO, Saurabh Govil. As usual, our CEO will kick things off with brief remarks about our earnings this second quarter, and then our CFO will provide a detailed financial overview. This quarter, you will also get to hear from our COO about an update with our business transformation plans. So with that, let me pass the mic over to our CEO, Thierry Delaporte.
Thank you, Sandabar. All right. Good afternoon, everybody. Thank you for joining our second quarter earnings press conference here in Bangalore. My executive team and I are, as always, glad to have you here. I'd also like to welcome Aparna, our new CFO. Aparna, great to have you here with us for your first earnings press conference. So, I'll begin today's conference with an overview of this quarter's results, details of our sectoral performance, the demand environment for sure, and the directions for the coming quarter. Q2 was yet another quarter of strong deal bookings. In total contract value terms, we closed large deals to the tune of $1.3 billion. This is the highest in the last 9 quarters, and this represents a 79% year-on-year growth and a 6% growth on a quarter-on-quarter basis. We booked as many as 14 deals in the greater than $30 million TCV range, versus 10 in the previous quarter. Total bookings from a TCV standpoint stand at $3.8 billion, which is a growth of 6% year-on-year. We added 1 new account in the greater than $100 million client category in Q2. We now have 22 accounts in that bucket. If you remember, we had 11 $100 million accounts in FY24. So we've doubled the number of accounts in the $100 million category. We have also won 2 close to $500 million deals in 2 of our large accounts. As has been the case for several quarters now, cash flow also has remained strong, but 145% of net income in Q2. EBIT, or earnings before tax and interest, of our IT services segment has increased 6% year-on-year. So it gives us great confidence that we are winning in the market against the backdrop of economic weakness. The business environment, as you all know, has been uncertain. Inflation has stayed high, as have interest rates. Clients are continuing to take a much more rigorous look at their investments. That is clear. They are hyper-focused on efficiency, on optimization of existing investments, and faster return on new ones. So, lower discretionary spending is a reality today. Conversion of order book has become slower. Transformation programs that are nearing their project terms are being replaced by new ones, but at a slower pace. All of this has impacted our top-line growth as well. In Q2, revenue declined 2% quarter-on-quarter in constant currency terms. But even though there's some softness in top-line growth, we are continuing to hold margins steady. Operating margin for the first half of fiscal year 24 was 16.1%. This is 110 basis points higher than our operating margin in the first half of fiscal year 23. Now let's look at our strategic market unit, our four strategic market unit. In our Americas 1 market unit, revenues grew 1% quarter-on-quarter in constant currency terms in Q2. This revenue growth was led by strong performance in our healthcare business, as well as in the technology, the products and platforms business. Order bookings, in terms of total contract value terms, grew 36% year-on-year. Our Americas 2 market, unusual impact of the macroeconomic slowdown. Revenues in our Americas 2 market declined 2.3% quarter-on-quarter in Q2. Europe has been a growth engine for the last 2 years, you know that, growing by 39% in FY22 and 12% in FY23. But slowing demand and reprioritization of client spends has weighed on our European business. As a result, revenues in this market declined 5% quarter-on-quarter. But we are seeing strong traction on the order booking side, which in total contract value terms increased 10% in Q2 year-on-year. So given our strong bookings in this market, we are confident of a swift rebound. Finally, in our APMEA market, revenues for the quarter declined 0.5% quarter-over-quarter. Our goal in this region is to capture the rapidly digitizing market. We are leveraging our global scale and domain expertise to continue to move our portfolio towards higher value transformation projects. This focus on improving the quality of revenue is now clearly reflecting in our margin performance, which has improved 330 basis points over the last 5 quarters. Being able to sustain margins despite softer revenues is largely due to our ongoing transformation efforts. This includes several programs around delivery excellence and operational efficiencies. Across the board, we are pivoting our business towards high quality, high potential businesses and reducing our loss-making accounts. We are working on faster bench deployment. In the last quarter, utilization increased to 84.5%, an improvement of 80 basis points quarter-over-quarter. Our account segmentation strategy, together with a One Wipro approach, is definitely helping us seal bigger deals with existing clients and win in a consolidating market. And I'm proud that we are seeing these benefits within 3 months of moving to the new 4 global business line operating model. Amit will share more details shortly. Both on the delivery assurance and efficiency side, these actions are having an immediate positive impact, while also setting us up for long-term margin resilience. Because profitable and sustainable growth is our top priority. In Europe, we closed 3 large consolidation deals in Q2 at a 100% bid to win rate. Example, a global bank has selected Wipro as its partner to deliver multi-year digital transformation initiatives. For that, Wipro will work with the bank to build bespoke solutions to enhance its global products and services through responsible use of AI and hyper-automation. This will deliver superior customer experience, better use of data, better use of analytics, and drive significant operational efficiency. Our partnership strategy continues to stay strong as well. Bookings through our partners as a percentage of total bookings have continued to increase from 25% in fiscal year 20 to 44% in FY23. And actually this quarter it was at 53%, so 10% more. What are we seeing? Increasingly, clients are not just looking to migrate to the cloud, but also run and grow their businesses more efficiently on the cloud. Our full stride cloud services is setting us apart from competition and letting us tap into opportunities across the cloud journey. For example, a multinational healthcare and insurance firm wants us to co-create their consumer and digital experiences. As a strategic technology partner, we will build AI and automation solutions to drive speed to market, better client experience, and of course, reduce their cost. Our high-performance software engineering program will bring them at least 20% efficiency. Overall, this engagement will strengthen the client's workforce management strategy and expedite our tech rollouts. Now, if you look at the bigger picture in this, what you'll see is that our ongoing transformation is driving a substantial improvement in our market position. And that's, in turn, reflected in the types of deals we are winning as well. Clients now look to us to help them solution and orchestrate their transformation. They trust us with their complex challenges. That's reflecting in the latest customer satisfaction survey as well, with our NPS, Net Promoter Score, expanding by 840 basis points, which is very significant. I'll take a few minutes now to share an update on Wipro's AI 360 strategy. Since our announcement last quarter, we have trained 180,000 employees in basic Gen AI principles. We have rolled out persona-based learning pathways to create a pool of specialized talent with deeper technical expertise. We are working with our alliance partners to further enhance AI learning pathways through our AI and cloud academies. Recently, we launched a new Gen AI Center of Excellence with IIT Delhi. We are very rapidly integrating Gen AI into our processes, our solutions, our offerings. Thousands of our employees have or are starting to use Gen AI. In the HR function, for example, our teams are seeing significant productivity gains by using Gen AI for candidate background verification. Then, in marketing, we're using Gen AI for content generation and translation. Tasks that used to take hours earlier now takes minutes. In sales, we're implementing Gen AI to do market research, improve sales collaboration, but also generate RFI responses. In our engineering business, GenAI is helping with software development and lifecycle automation. One of the areas with the biggest productivity gain is in quality engineering and in quality assurance testing. GenAI is helping with scenario creation, code generation, synthetic data creation, as well as execution at scale. Initial pilots of these GenAI apps have been so successful that we are now rolling them out to all our employees. On the client front, GenAI is now a part of every client conversation. There's tremendous interest in exploring new use cases, as well as understanding the benefits and the implications of this technology. Imagine the number of GenAI active projects have doubled than just 1 quarter ago. For now, we are seeing rapid adoption in healthcare, in consumer, in financial services, and I would say with high tech and utilities following closely. One example I can share with you here is we're working with a US-based health insurer to deploy a Gen AI-based chatbot for their agents. We're developing a solution that is fine-tuned to be more contextual, so that agents can provide more personalized assistance. The solution is driving 30 to 40% reduction in operations cost, significant improvements in agent productivity, of course, and therefore improving net promoter scores. Another example. We are working with a European multinational telecom company to unlock value from data. Working with different vendor tools and software kits, we are generating high-quality synthetic data, which allows the client to increase cross-border collaboration, mitigate bias, and eliminate distribution limitations that exist in real data. As the technology evolves and GenAI output becomes more accurate, we expect demand for our GenAI services and expertise to increase greatly over the next 6 to 12 months. Frankly, we're very excited by the opportunities GenAI presents, and we're investing in new use cases, solutioning for clients, as well as upskilling our employees, because we want to take a leadership position in this space. A word here on our guidance now. For the next quarter, we're guiding for a sequential growth of -3.5% to -1.5% in constant currency terms. We expect margins to stay range-bound, as we've seen over the last few quarters. As the markets start to turn around, on the back of our transformation and efficiency plays, we expect to start seeing improvements in the coming quarters. Despite the global slowdown, Wipro will continue to invest in its people through training opportunities, leadership development, global exposure to new clients and technologies, and by rewarding them with merit-based salary increases. Wipro's intellectual capital, our people, are definitely our biggest strengths. We're continuing to strengthen our foundation, streamline our operations, and moving towards a more modern, dynamic culture. We have the right strategy, vision to keep us competitive and resilient. With that, I'll turn it over to Aparna for her comments. Thank you.
A very, very good evening to everyone joining us today. In my update, I will cover some key financial highlights for our performance during the quarter. Our IT services revenue for Q2 decreased 2% quarter on quarter in constant currency terms which was at the lower end of our guided range for the quarter. We are happy to report another quarter of healthy deal bookings. In total contract value terms, we closed large deals to the tune of USD $1.3 billion, which is a 79% year-on-year growth. We also booked 14 deals with greater than $30 million of TCV range. Total bookings from a TCV standpoint stands at $3.8 billion US, which grew 6% year-on-year. Turning to margins. Our ongoing focus on operational improvement has ensured that our margins remain steady even in a softening revenue environment. Our operating margins for the second quarter was 16.1%, which is an expansion of 100 basis points year-on-year. Shifting to our cash flow performance for the quarter, our operating cash flow for Q2 was rupees 38.6 billion, which was 145% of our net income. Our free cash flow as a percentage of net income was 149%. Cash conversion has been strong even in the first half at 137% of our net income. At the end of Q2, we had $4.1 billion of gross cash and $2.2 billion of net cash on the balance sheet. Now let me share certain other important details relating to the financial performance. Net income attributable to shareholders for the quarter was at INR 26.5 billion rupees. Our EPS grew 4.1% on a year-on-year basis. Our effective tax rate remained flat during the quarter at 24%. On the forex front, we realized our dollar rupee realizations in IT services for Q1 was at rupees 82.54. Our DSO for the quarter at 79 showed an improvement of 3 days year-on-year. Over to the guidance for the next quarter. Our guidance outlook for the IT services business segment is to be in the range of 2.617 billion to 2.672 billion. This translates to a sequential guidance of negative 3.5% to negative 1.5% in constant currency terms. Thank you, and over to Amit.
Hello, everyone. I'll share some updates on our business transformation and how it's reflecting in our steady margin performance. Our new 4 global business line model has allowed us to deliver a one Wipro service excellence approach to our clients. It is reflected in our latest customer satisfaction survey, with our NPS expanding over 840 basis points. This directly reflects our performance with the clients, delivery, program governance, and our capabilities that is setting us up for further strengthening our delivery-led sales. On the delivery excellence side, we have been very focused on consistent, efficient, and productivity improvements for our clients. Automation and Gen AI is our cornerstone here, with the corresponding productivity kicking in both on delivery and functional sides. Over the last quarter, on our operational efficiency front, utilization is now at 84.5%. In fact, utilization has increased by almost 470 basis points in the last 4 quarters, including utilization of our next-gen associates. We have taken several actions here, from sustained bench reduction to pyramid optimization to onshore-offshore rationalization and rigor around our subcontracting costs. Alongside, we are keeping a close eye on discretionary spends with increased rigor on cost and efficiency management. Thierry has talked about skill being our biggest currency. On the talent reskilling side, we continue to scale Gen AI talent. As you heard, over 180,000 of our employees have taken the first level Gen AI course. Focused upskilling initiatives across skill families are in place now, including several account academies. These are collaborative initiatives with our clients They're providing us a skilling roadmap for our teams to serve them better. I'm pleased with the progress that we have made so far, and a lot more lies ahead. Now, I turn it over back to Sanubal.
We're now going to start the Q&A. If you have a question, please raise your hand and wait for the microphone to be passed on to you. We ask that you please introduce yourselves before you ask your question, and please try to limit your questions to one so everyone can get a chance to speak to our executives. Thank you.
Hi, I'm Ritu Singh from CNBC TV 18. The first question is on your constant currency revenue growth. For 3 quarters now, we've seen a decline. And your guidance for the next quarter as well also shows a negative growth of 3.5% to -1.5%. While your peers are also talking about this slowdown in the discretionary spend, why such a drastic reduction in, sort of guidance? It's much below what the street had also factored in. Where are you seeing this weakness apart from, the larger markets that you've highlighted? And when is that turnaround that you're talking about going to start to materialize? And if you can add a word on the margin levers as well that you're using to get to that aspirational level of 17%. And one question for Saurabh as well. There's been a decline in the headcount, which has continued, I think, for the last 4 or 5 quarters now. Any hiring plans for the year, or, given that we're getting into the December season, will you stay away from campuses for the year?
Okay, all right. So let me respond to the first part of the question. For several years, we've had a market of growth where, we've been able to grow quite significantly. Over the last few quarters, what have we seen? And I think I'm reflecting for the industry. What we have seen is that, on the one hand, there's a good volume of business, and on the other hand, there is a significant reduction of discretionary spend from clients. Bottom line is there is not the same level of growth in the market that what we had before. For us, it's a fact. We are not growing. You said it, definitely. And that's, a reality. But what's key for us is to make the right investment, make the right decisions now to make sure that when the market picks up again, we are ready. So it's about, making the right investments. It's about, working on our efficiency model, what Amit described. It's about continuing to invest in larger deals, win those large deals. You've seen this is the best quarters we've had in terms of large deals, and I think it's an encouragement on the fact that we continue to get better quarter after quarter on winning those large deals. So, and then, the work on the margin, what is clear is that, despite a market where there is no growth, we are doing what's required to maintain our level of margins to the place that we've, delivered on for the last quarters through, efficiency program, working on how agile we are. We've made an organizational adjustment 3 months ago with the creation of 4 GBLs. Just allows us to be more agile, more nimble. We also continue to invest in our account strategy. And I think it's very, very important. When the market will pick up again, this will pay off. Saurabh?
So hiring, it's a function of, our current supply chain in terms of the demand we have, the bench we have.